The uncomfortable question, what if the safest decision you've made with your money is quietly costing you the most? Not through a sudden loss, not through a market crash, but slowly, year after year, almost too quietly to notice. Because most financial mistakes don't feel like mistakes in the moment. They feel responsible, sensible, even disciplined. If you're in your 40s or 50s or getting closer to retirement, you've probably started thinking differently about money. Earlier in life, the focus was growth, earning more, saving more, building something over time. But now, the conversation shifts. It becomes about protection, about reducing risk, about making sure you don't lose what you've spent decades building. And somewhere along the way, a very simple idea starts to take hold. Play it safe. It sounds logical, almost unquestionable. After all, when you're younger, you have time to recover from mistakes. When you're older, that margin feels smaller. So naturally, people begin to move their money into places that feel stable. Cash, savings accounts, low-yield deposits. Nothing exciting, but nothing scary either. And emotionally, that decision brings relief. No market volatility, no sudden drops. No stress from watching numbers go up and down. Just stability. But here's the uncomfortable part. Most people don't stop to think about, what if that feeling of safety is actually an illusion? Not a dangerous one. Not something dramatic, but something subtle. Because while your money appears stable on the surface, the world around it is not. Prices change. Costs rise. Everyday life quietly becomes more expensive. And unlike a market crash, this doesn't happen all at once. It happens gradually, predictably, almost invisibly. Which is exactly why it's so easy to ignore. You don't wake up one day and feel poorer. Instead, you notice small things over time. Groceries cost a bit more. Healthcare expenses increase. Housing, utilities, insurance, they all slowly move upward. And if your money isn't growing at the same pace, then something important begins to shift. Not your balance, but your purchasing power. The lifestyle your savings were meant to support starts to quietly shrink. And this is where the real question begins, not just about investing, but about how we define safety itself. Is safety simply avoiding loss? Or is it making sure your money continues to serve you for as long as you need it? Because for many people, especially after 60, the biggest financial risk isn't losing money in the market. It's something far less visible, holding on to money that slowly loses its strength while everything around it keeps moving forward. Let's step into a situation that's very common across the United States and Europe. A couple in their early 60s. They've worked consistently for most of their lives, 30, maybe 35 years. Nothing extraordinary, no huge windfalls. Just steady income, gradual progress, and a focus on responsibility. During their peak earning years, they were bringing in somewhere between $5,000 and $7,000 a month before taxes. After taxes and deductions, maybe $4,000 actually reached their bank account. And like most households, that money had somewhere to go. A mortgage or rent payment that took a significant portion. Car payments sometimes one, sometimes two. Monthly insurance costs, groceries, utilities, fuel. And then the less predictable expenses helping children through college. Occasional medical bills. Credit card balances that came and went. Nothing irresponsible. Just the normal cost of maintaining a middle-class life. Over time, they managed to save. Not perfectly, not aggressively, but consistently enough. Maybe through a workplace retirement plan, maybe some personal savings on the side. By the time they approach retirement, they've built something meaningful, let's say somewhere between $250,000 and $400,000. It's not wealthy by headline standards, but it represents decades of effort, discipline, and trade-offs. Now comes the transition. The paychecks slow down or stop entirely. The focus shifts from earning to preserving. And this is where a very predictable decision happens. They begin moving their money out of anything that feels uncertain. Stocks feel unpredictable. Markets feel volatile. So they simplify. Cash, savings accounts, fixed deposits, low yield, stable options. It feels like the responsible move. After all, at this stage, the goal isn't to take chances. It's to protect what's left. And emotionally, this decision makes complete sense. There's a sense of control, of clarity, of finally stepping away from financial stress. No more worrying about market swings. No more checking balances during downturns. Just stability. But there's something subtle happening underneath this decision. Because while their investments have become stable, their expenses have not. The cost of living doesn't pause for retirement. Groceries still rise. Healthcare often becomes more expensive with age. Utilities, insurance, property taxes, they continue adjusting upward. And unlike income during working years, there's no easy way to earn more to compensate. So now, the same savings that once felt sufficient must stretch further, for longer, under changing conditions. And this is where the situation becomes quietly complex. On paper, everything looks fine. No losses, no risky investments, no major financial mistakes. But in reality, the environment around their money is changing even if their money itself is not. And that gap between a stable portfolio and a rising cost of living is where long-term pressure begins to build. Not suddenly at all, not dramatically, but slowly, in a way that's easy to miss at first and much harder to correct later. The hidden financial mistake on the surface, nothing about this approach seems wrong. In fact, it looks responsible. You've reduced exposure to market swings. You've protected your savings from sudden drops. You've created a sense of stability. And for many people, that stability feels like success. But the issue isn't what you can see, it's what you don't. Let's walk through a simple example, nothing complex, just basic math. Imagine you have $300,000 in retirement savings. You place most of it into safe, low-yield options earning around 2% per year. That gives you about $6,000 annually in growth. On paper, that feels like progress. Your balance is increasing, not decreasing. But now consider the other side, inflation. Historically, in many developed economies, inflation has averaged around 3%, sometimes higher, sometimes lower, but consistently present. That means the cost of living rises by roughly 3% each year. So while your money is growing at 2%, your expenses are growing at 3%. And that 1% gap may not sound like much, but over time it compounds. Not in your favor, but against you. After 10 years, that $300,000 doesn't feel like $300,000 anymore. Its purchasing power, the amount of life it can actually support, has quietly declined. It may function more like $230,000 or $240,000 in today's terms. After 15 or 20 years, the difference becomes even more noticeable. And here's what makes this particularly important. Nothing went wrong. There was no bad investment, no market crash, no financial misstep. The loss happened quietly, through time, through inaction, through a strategy that focused on avoiding visible risk while ignoring invisible erosion. This is the hidden mistake. Not that people are being careless, but that they are being incomplete in how they define safety. Because safety isn't just about preserving the number in your account. It's about preserving what that number can actually do for you. A stable balance can still represent declining value. And in retirement, that distinction matters more than ever. Because your savings are no longer just numbers on a screen. They represent years of future living, monthly expenses, healthcare needs, unexpected costs. And when those costs rise even gradually, your money needs to keep up. Otherwise, the pressure builds slowly. You may not notice it in the first few years, but over time it shows up in subtle ways, being more cautious with spending, delaying certain decisions, feeling less financially flexible than expected, not because you didn't save enough, but because your money wasn't positioned to maintain its strength. And this is where many retirees find themselves confused. They did everything right, saved consistently, avoided major risks, made disciplined choices. Yet somehow, the outcome feels tighter than expected. The reason isn't dramatic. It's structural. A strategy designed to protect money that doesn't fully protect its long-term value. And that difference, small at first, is what slowly shapes the financial reality of retirement. The psychology behind playing it safe. So if the math is relatively simple, why do so many people still choose this path? Why would someone spend decades building savings, being disciplined, avoiding unnecessary risks, only to place themselves in a position where their money slowly loses strength? The answer isn't really about logic. It's about how we experience risk. Because not all risks feel the same. When the stock market drops, the loss is visible. It's immediate. You can see the numbers change. And that visibility creates discomfort. Even if the decline is temporary, it feels real in the moment. It feels like something is going wrong. Now compare that to inflation. There's no chart you check daily that shows your purchasing power declining. No alert that tells you your money is slowly becoming less effective. Instead, it shows up in small, scattered ways. Groceries cost a little more than they used to. A medical bill feels slightly higher than expected. Insurance premiums increase without much explanation. Each change is manageable on its own. So it doesn't trigger the same emotional response. But over time, these small increases accumulate into something significant. And because the change is gradual, our minds don't treat it as a threat in the same way. This is a natural human bias. We tend to react strongly to sudden visible losses and underestimate slow, invisible ones. There's also another layer to this. As people get older, their relationship with money changes. In earlier years, risk is often associated with opportunity. Investing feels like growth. Taking calculated risks feels acceptable, even necessary. But after 50 or 60, the perspective shifts. Now, risk feels like something to avoid. The focus moves from building wealth to protecting it. And that shift is understandable, because at this stage, time feels more limited. There's less room to recover from mistakes, less willingness to tolerate uncertainty. So the definition of good financial behavior becomes more conservative. Avoid loss. Stay stable. Don't take chances. And emotionally, this feels responsible. But there's a subtle problem hidden inside this mindset. It assumes that avoiding visible risk is the same as avoiding all risk, which isn't true, because there are different types of risk. There's market risk, the kind people see and react to. And then there's purchasing power risk, the kind that works quietly in the background. When people focus only on the first, they often expose themselves more to the second, not intentionally, but unintentionally, through caution. There's also comfort in simplicity. Keeping money in cash or low-yield accounts feels easy to understand. There's no complexity, no need to monitor markets, no decisions to revisit. It creates a sense of control. And after decades of managing financial responsibilities, that simplicity can feel like a reward. But financial reality doesn't adjust itself to match our comfort. It continues moving through inflation, changing costs, and time. So while the strategy feels calm and controlled, it may not be fully aligned with what the money actually needs to do. And that's the core of the psychological trap. People aren't making reckless decisions. They're making careful ones based on how risk feels, rather than how it actually works. And over long periods, that difference quietly shapes the outcome. How financially aware people think differently at a certain point. Financially aware people stop asking a very common question: where can I keep my money safely? And start asking a slightly different one: how can my money keep its purpose over time? That shift may sound small, but it changes everything, because it moves the focus away from fear and toward function. Money, especially after retirement, is not just a number sitting in an account. It's not just something to protect from losses. It has a job. It needs to support living expenses. It needs to keep up with rising costs. It needs to remain relevant not just today, but years into the future. And financially aware individuals understand that doing nothing with money is not the same as keeping it safe. They recognize a simple reality: time affects money, even when nothing appears to be happening. So instead of thinking in extremes like high risk or no risk, they think in terms of balance and purpose. They don't try to eliminate uncertainty completely, because they understand that in real life, that's not possible. Instead, they try to distribute it intelligently. Some portion of their money is kept in highly stable places, enough to handle immediate needs, emergencies, and short-term comfort. But another portion is allowed to remain active in the financial system in a controlled way, not aggressively, not speculatively, but with intention. The goal is not to chase high returns. The goal is to avoid silent decline, because they understand something important. Inflation doesn't stop working just because you choose to avoid risk. It continues regardless of your comfort level. So if all money is placed in very low growth environments, the overall system slowly loses strength. Financially aware people accept this trade-off consciously. They don't assume safety comes from avoiding all movement. Instead, they understand that safety comes from maintaining stability and sustainability together. Another key difference is how they view volatility. To many people, volatility feels like danger. Up and down movements in markets create discomfort. They feel unpredictable, even threatening. But experienced investors often interpret volatility differently. They don't automatically see it as loss. They see it as variation, something that exists in exchange for long-term growth potential. This doesn't mean they ignore risk. It means they contextualize it. They separate temporary fluctuations from permanent outcomes. And more importantly, they avoid making long-term financial decisions based on short-term emotional reactions. There's also a mindset shift around time itself. Many people think of retirement as a phase where financial activity slows down significantly. But financially aware individuals see it differently. They view retirement not as the end of financial planning, but as a different stage of financial design. A stage where the goal changes from accumulation to sustainability, from building wealth to maintaining it, from maximizing returns to preserving purchasing power and independence. And this perspective leads to calmer decisions. Not because the environment becomes easier, but because expectations become clearer. There's less emotional reaction to market noise, less pressure to react quickly, more patience in allowing strategies to play out over time. Most importantly, there's an understanding that money is not static. Even when it looks stable, it is still moving through time. And if it is not actively positioned to keep up with that movement, then even a safe strategy can slowly become misaligned with reality. This is the quiet difference between simply protecting money and actually managing it for long-term life stability. At the end of all this, there's no dramatic twist, no sudden financial secret, no hidden strategy that changes everything overnight. Just a quieter realization that money in retirement is not only about what you saved, but about what your savings can still do over time. Many people spend decades focused on one goal, building enough to finally feel secure. And once they reach that point, the natural instinct is to protect it as much as possible. That instinct is not wrong. In fact, it's understandable and, in many ways, necessary. But the challenge begins when protection becomes the only focus, because money doesn't exist in isolation. It exists in a changing environment. Prices move, costs adjust, healthcare needs evolve. Everyday life becomes more expensive in ways that are slow but consistent. And so, even when your savings remain unchanged on paper, their real-world strength can still shift over time. This is where many retirees quietly feel a difference they didn't expect. Not a sudden financial crisis, not a visible loss, but a gradual reduction in flexibility. A sense that money doesn't stretch as far as it once did, that decisions require more consideration, that comfort needs more planning than before. And this often leads to confusion, because from their perspective, they did everything correctly. They saved consistently, they avoided unnecessary risk. They chose stability over speculation. And yet, the outcome doesn't fully match the expectation. The important thing to understand is that this is not a failure of effort. It's a mismatch between strategy and environment. A financial approach designed to eliminate visible risk in a system where invisible changes still continue. The key idea here is not to swing in the opposite direction. It is not about becoming aggressive. It is not about taking unnecessary risks late in life. And it is certainly not about chasing returns. It is about awareness. Understanding that safe is not a fixed definition. It changes depending on time, inflation, and lifestyle needs. And that money in retirement has a different job than money in earlier years. It is no longer just about growth. It is about continuity, continuing to support your life, continuing to match rising costs, continuing to provide independence without stress. When that perspective is clear, financial decisions become less emotional, less reactive, less fear-driven, more structured, more intentional, and most importantly, more aligned with reality. There is no perfect allocation that guarantees comfort forever. There is no single formula that removes uncertainty completely. But there is a meaningful difference between ignoring long-term changes and preparing for them in a balanced way. And that difference is often what separates financial pressure from financial stability later in life. If there is one simple takeaway, it is this: safety is not just about protecting what you have. It is also about ensuring it continues to function in a world that keeps changing. And if this way of thinking helped you see money a little more clearly, you can subscribe for more calm, realistic financial perspectives like this.